pleasant day again to all of you. We are now on the third and final part of our video to complete our discussion of IFRS 16 leases. So allow me to share my screen. So in this last video, we will be discussing accounting for sale-leaseback transaction. So we will address the following learning outcomes. So after viewing this video, you should be able to describe the nature of the sale-leaseback transaction, account for the sale-leaseback transaction in the books of the seller-lessee, account for the sale-leaseback transaction in the books of the buyer-lessor, and identify the effects of IFRS 16 on other IFRSs. Okay, so what is a sale-leaseback transaction? A sale-leaseback transaction is one when the original owner of the asset is in need of cash. So one remedy for this owner is to sell the asset to another party. However, this owner of the asset still has the need to use the asset, so immediately after the sale, such owner, which now becomes the seller, leases back from the buyer the underlying asset. Therefore, the owner later on becomes the seller, and the seller becomes the lessee. The buyer, therefore, is the lessor. So, what will be our accounting concepts for sale-leaseback transaction in the books of seller-lessee? So, in the books of seller-lessee, you are to determine whether a performance obligation has been satisfied. So, you are to determine whether there is an obligation by the seller that is satisfied, meaning that the right to direct the use of the asset has been transferred from the seller to the buyer, or the economic benefits from the asset already accrues to the buyer. Therefore, if the performance obligation is satisfied, recognize the right of use asset. So, upon sale-leaseback, we are to recognize the right of use asset at the proportion of the carrying amount of the underlying asset that relates to the right retained. And may I clarify, in the sale-leaseback transaction, after the leaseback, the portion that is being leased by the seller from the buyer is actually the right retained. So that right retained will be recognized as the right of use asset. So it may be in cases such that the lease term may not be equal to the remaining useful life of the asset. Therefore, there is the right that is disposed of. So you are to split the underlying asset to the right retained, which equals or approximates the present value of your rental payment, and for that retained, no gain or loss will be recorded on the sale. You are to recognize gain or loss relating only to the right transferred to the buyer-lessor. So, to illustrate, we will be using some illustrative problems. So, assume that equipment with carrying value of 4 million was sold for 5 million, which is the fair value. The seller immediately leased back the equipment for 5 years at an annual rental of 800,000. The market rate of interest at the date of leaseback is 6%. Okay, so let us compute for the fair value of the right retained. the fair value of the right retained is considered to be the present value of the rental payments discounted at 6%. And because this is made in advance, that means we will be using the present value of annuity due for 5 years at 6%. So we have this computation. So the present value of the rental payment is 800,000 times the PV factor at 6% for 5 years using present value of annuity due because payment is made in advance. So that is 3,572,080. The selling price is 5 million. So if from 5 million, the selling price of the right retained is this amount. Therefore, the difference is the selling price of the right disposed of. Based, therefore, on this proportion, we will be allocating the carrying value. So we will allocate the carrying value between the right retained and the right disposed of based on this proportion. So the carrying value of the underlying asset is 4 million. So to arrive at its estimated carrying value, that is 3,572,080 divided by total selling price of 5 million, which is the fair value, times 4 million. So that is 2,857,664. So 4 million minus 2,857,664 is 1,142,336, which is the same as the proportion of the selling price of the right disposed of to the total selling price multiplied by the carrying value of 4 million. So let us split both the selling price and the carrying value in a matrix format. So this is it. This is the total selling price. This is the selling price of the right retained. This is the selling price of the right sold. The carrying value is 4 million. So based on this proportion, we allocate the carrying value of 4 million such that the carrying value of the right disposed of is 1,142,336. Inasmuch as this is retained, then we will not be recognizing any gain or loss because in effect there is no transfer of right because this is retained. So before the sale-leaseback, the asset is controlled by the seller-lessee. After the sale-leaseback, this portion of the asset is also retained by the seller-lessee. Therefore, for the portion retained, we will not be recognizing any gain or loss because in effect there is no transfer, but we will just be transferring its carrying value to another asset account, which is right of use asset. So our entry will be to debit cash for the total selling price of 5 million, debit right of use asset for the proportion of the carrying value of the right of use asset or the right retained, credit lease liability for the total present value of the periodic payment, including the payment that is due immediately, credit the asset 4 million, and credit gain on sale of asset relating only to the portion sold 285,584. Again, this gain pertains only to the portion that is disposed of. Then, because the payment of rent is made in advance, we are to reduce immediately the lease liability. So, debit lease liability 800,000 and credit cash 800,000. So, this is your sale-leaseback and this is your payment at commencement of the first rental payment. Then, the payment of the lease liability will be recorded in the same manner as we have discussed in part 1. The succeeding payment will have to be applied partly to interest and the remainder of the periodic payment will be applied to principal. At the end of the year, you are to depreciate the right of use asset based on the lease term only of 5 years in our example. In some cases, the selling price may not necessarily be equal to the fair value of the asset. So, if in another circumstance, the agreed selling price is more than the fair value, the excess of the selling price over this fair value is treated as additional financing granted by the buyer-lessor. So, the seller-lessee deducts this difference from the present value to arrive at the fair value of the right retained, meaning that the right retained has an amount of fair value lower than what is expected. So, assume now that equipment with carrying value of 4 million, fair value of 5 million, was sold for 5,500,000. So, the selling price is more than the fair value by 500,000. The seller immediately leased back the equipment for 5 years at an annual rental of 800,000 in advance. The market rate of interest is 6%. So the present value of the periodic payment will still be equal to the amount that we computed in illustration 1, except that the 500,000 excess of the selling price over the fair value will be deducted from the present value to arrive at the fair value of the right retained. Hence, we have this modified computation. This is the present value of the periodic payment reduced by the excess of the selling price over the fair value. So, the assumed fair value of the right retained is now lower. So, it is now 3,072,080. Deduct 3,072,080 from 5 million. So, the fair value of the right sold is 1,927,920. Based on this proportion, allocate now 4 million carrying value. So, the carrying value that is allocated to the right retained is 2,457,664, and the carrying value that is allocated to the right sold is adjusted to 1,542,336. So, only this gain pertaining to the right sold will be recognized in the books of the seller-lessee. So, our entry debit cash for the selling price, which is now 5,500,000. Debit right of use asset for 2,457,664. Credit lease liability is still equal to the present value of the periodic payments. Credit the asset at the carrying amount of 4 million and credit this gain pertaining to the portion sold, 385,584. Then record the immediate payment of the first rental, which is due immediately. Debit lease liability 800,000 and credit cash for 800,000. What if we have the reverse situation? So, if the selling price now is less than the fair value, then the difference is treated as prepayment of rent by the seller-lessee. Therefore, the fair value must be the amount that we should receive from the buyer. However, the selling price is lower. Therefore, this difference is considered to be a prepayment of rental by the seller-lessee. Therefore, the seller-lessee adjusts the present value to arrive at the fair value of the right retained. So, to illustrate this, again, equipment with carrying value of 4 million is still with fair value of 5 million, was sold for 4,500,000, so it's now 500,000 lower than the fair value. The seller immediately leased back the equipment for 5 years at an annual rental of 800,000 in advance. The market rate of interest is 6%. So, we revise our computation now. This is the present value of the periodic payment. However, the excess of the fair value over the selling price is considered to be prepayment of rental. So, this present value is increased by this difference of 500,000. So the fair value of the right retained is considered to be 4,072,080. So 4,072,080 is deducted from 5 million. So this difference of 927,920 is presumed to be the selling price of the right disposed of. Based therefore on this proportion of 4,072,080 and 927,920, we allocate 4 million carrying value between the right retained and the right disposed of. Again, relating to the right retained, no gain or loss is to be recognized, but relating to the portion that is sold, we will be recognizing gain of 185,584. So our entry is to debit cash for the selling price, which is now lower by 500,000. So debit cash, 4,500,000. Debit right of use asset at a higher amount, 3,257,664. Credit lease liability at the same present value because the periodic payment is still the same amount. Credit asset at the carrying amount of 4 million. And credit gain on sale of asset pertaining only to the right sold, 185,584. Then recognize or record the immediate payment. Debit lease liability 800,000, credit cash for 800,000. Again, your subsequent payment of the periodic rental that will be next period is considered to be payment allocated to interest, and then the balance allocated to reduction of principal. Now, we go to the second circumstance. In the transfer of an asset by the seller-lessee does not satisfy the requirements of sale under IFRS 15. So, it is not a sale transaction. Then the seller-lessee shall continue to recognize the asset and shall recognize a financial liability equal to the transfer proceeds. Therefore, what is the substance of this transaction? So the seller-lessee simply uses the underlying asset as collateral to obtain loan from the buyer-lessor. Therefore, the buyer-lessor, in effect, just lends money to the seller-lessee. So if it is a borrowing transaction, then it will have to be recorded as a borrowing transaction, wherein we debit cash and credit a financial liability account. Then the periodic payment of the rental will be recorded as a reduction of the financial liability. So if immediate payment is made at the same date of the sale, then we debit financial liability and credit cash. Then for the subsequent payments, of course, because financial liability is carried at amortized cost, then the periodic payment is allocated between payment applying to interest and payment applying to reduction in principal. Okay. We now go to the buyer-lessor. So, in a sale and leaseback transaction, if the transfer is a sale under IFRS 15, the buyer-lessor shall account for the purchase under applicable IFRS. Therefore, if this is really a sale transaction, then the buyer-lessor will recognize an asset. So it is to apply for that acquisition, let us say IAS 16, for the purchase of an asset under installment basis, or for the purchase of asset on cash basis because cash is immediately paid in full by the buyer-lessor. Or if it is an investment property, then the purchase price is debited to an account of investment property, and so on. Then the lease will be accounted for by the buyer-lessor under this standard IFRS 16. Therefore, the buyer-lessor shall determine whether the lease is to be accounted for as operating lease based on the absence of finance lease indicators. So if all of the finance lease indicators are missing, then that's operating lease. Otherwise, it will have to be accounted for as finance lease, either direct finance lease or manufacturers or dealers lease, depending on the nature of business of the buyer-lessor. If the transfer of asset by the seller-lessee does not qualify as a sale under IFRS 15, so it is not a sale. Therefore, this buyer will not recognize the asset, but this buyer actually provides credit to the seller-lessee. In effect, this is a borrowing transaction wherein we are the creditor. So the buyer-lessor shall not recognize the transferred asset and shall recognize only a financial asset. That financial asset is actually a receivable. In effect, we are lending our money to the seller-lessee. So if we are lending, then it will be accounted for as a lending transaction with debit receivable and credit cash. So for the immediate collection, debit cash, credit receivable. For the subsequent collection, debit cash, credit the receivable, and credit interest income. Of course, with appropriate adjusting entries at year end. So actually that almost concludes IFRS 16, but IFRS 16 has several effects on other IFRS. So for the right of use land and or building held by a lessee as a right of use asset, they shall be initially recognized and measured under IFRS 16. So if land and or building are leased by the lessee, so if land and building are leased, therefore we recognize right of use land or we recognize right of use building or both. So the initial cost that will be assigned to the right of use land and right of use building will be determined under IFRS 16. When a lessee uses the fair value model to measure an investment property that is held as a right of use asset, it shall measure the right of use asset and not the underlying property at fair value. Example, if an entity leases an entire floor of a building and this entire floor is converted into a dormitory that is being subleased to others under operating leases, then that entire floor of the building is a right of use building space that qualifies to be reported as investment property. So, because that is investment property, the fair value measurement is necessary. You have two options for the measurement of investment property, the cost model and the fair value model. So, even with the use of the cost model, it is a required disclosure that the fair value of that investment property be disclosed in the notes to financial statements. Of course, if the company uses the fair value model, on the face of the statement of financial position, such right of use building space will be measured at fair value. So fair value measurement is necessary whether the company uses the cost model, because that is to be disclosed in the notes, or if the company uses the fair value, such will be reflected directly on the face of the financial statements. Therefore, the fair value of the right of use asset shall be determined and not the fair value of the underlying property. In our example, what will be reflected as fair value of the investment property will only be the fair value of the right of use building space and not the entire building. Okay, so Completing therefore all the modules, all the 3 videos relating to the lease. At this time, you should be able already to state the nature of lease, identify its essential elements, and based on these identified elements, you can already decide whether the contract is a lease or whether the contract contains a lease. You should be able to account for leases in the books of the lessee, identify the proper measurement basis and classification of right-of-use asset and lease liability in the financial statements. In fact, after repeated exercises, you should be able already to present the right-of-use asset and the finance lease liability on the financial statements of the lessee. Also, you should present the related income and expenses relating to leases in the financial statements of the lessee. Again, you should be able to account for leases in the books of the lessor because this is done in Part 2. And similar to the lessee, you should be able to identify the proper measurement basis and classification of related assets and liabilities in the statement of financial position and related income and expenses in the statement of comprehensive income of the lessor. In this module, we have addressed recording sale and leaseback transactions, and we have identified the effects of IFRS 16 on other IFRSs, and all in all, we have identified the required disclosures in the financial statements of both the lessors and the lessees. Therefore, for our synchronous class, we will be discussing some exercises relating to the lessee, the lessor, and the lessee and lessor relating to sale-leaseback transactions. So, happy learning. Bye for now. I'm now stopping the sharing of my files and stop